Hello everyone, in this video we will take a look at 5 high income producing ETFs. As the name suggests, these ETFs are focused on high income, which means they are usually paying very high dividends. All of the ETFs we will talk about in this video have at least 7% dividend yield, which is quite high, but on the other hand, these sort of ETFs usually have a downside, and this downside is that they will not appreciate in price much. You see, in order to understand how these ETFs make money, you need to understand options. What they are essentially doing is they are selling options. So by selling these options, these ETFs are generating an income. And this income is later on distributed to shareholders via dividend. So the reason why these ETFs have this very high yield is because they are selling options. And what is the downside of selling options in this case? Well, in this case it means the assets that they are owning will not appreciate as much as the market. Nevertheless, if you are an investor who is focused on high dividend yield, these ETFs might be an interesting option for you. So let's get straight into the video and start with the number one ETF, which is JEPI. JEPI, as JP Morgan Equity Premium Income ETF, is an ETF which is focused on the income generations through selling options, just like I described. And this ETF is producing a very high dividend yield. Based on the last 30 days, the dividend yield is 14%. This is a huge dividend yield that this ETF is paying, especially if you consider that the average return of S&P 500 in the last 90 years was around 9% per year. So 14% dividend is very high. Now, before you get your hopes up, this dividend is based on the last payment only, right? This says 30-day SEC yield, which means it's based on this dividend, which was substantially higher than the rest of the dividends that were paid out this year. So I would say it is very unlikely to get this 14% dividend yield, but still I think you should be able to get at least 8% dividend yield, which is still pretty good. When we take a look at the portfolio of this ETF, it contains 126 stocks, and the top 10 holdings are AbbVie, Progressive, Exxon, Bristol Myers, Hershey's, United Health, PepsiCo, Honeywell, Coca-Cola, and Travelers. So you don't see many tech companies in the holding. The portfolio of JEPI contains mostly defensive, dividend-paying stocks. And this fund is actively managed, and the portfolio managers have over 16 years of combined experience in the industry. This ETF is also selling out of the money options on the S&P 500. And that's how they are able to generate these monthly high yielding dividends. Like I said at the beginning of this video, these income producing ETFs usually have a downfall of the low performance compared to S&P 500. You can see in the past few years that JEPI has been lagging the performance of S&P 500. You can see this red color is the performance of S&P 500, returning 35% to investors, where the JEPI had only 12% return. So even though if we account for dividends, this number is much closer, still JEPI would be underperforming the index S&P 500. Okay, the ETF number 2 is GEPQ, which is the JP Morgan Nasdaq Equity Premium Income ETF. So you may notice this is sort of like a brother of the other ETF we just talked about. You can though notice that this one has much higher dividend yield, which is reaching almost 20% based on the last 30 days. But when we take a look at the dividends that this ETF has paid in the history, you can notice that the last dividend was almost twice as large as the previous one. So this dividend ETF will likely be yielding somewhere around 10% per year, but this is highly depending on the amount of the options they will sell and how profitable that process will be. When you take a look at the portfolio and the holdings of these ETFs, you will see the clear difference between this ETF and JEPI. And the reason is this portfolio is much more tech heavy. It makes sense. This ETF has Nasdaq in the name. The number of holdings is 84, and the top holdings consist mostly of the big tech companies: Apple, Microsoft, Google, Amazon, and also Tesla. When we take a look at the overview of this ETF, it says that it generates income through a combination of selling options and investing in US large cap growth stocks, seeking to deliver a monthly income stream from associated option premiums and stock dividends. Again, the same applies for all of the ETFs we will talk about. This high dividend will most likely have an impact on the price appreciation of the asset. So this ETF doesn't have much history. The history dates to May of this year, which means it's only a few months since the inception of this ETF. When we take a look at the performance and compare it to the S&P 500, you can see that the S&P 500, which is the red line on this chart, delivered a minus 4.2%, and the JPQ delivered minus 10.9%, which is significantly lower. But on the other hand, it paid a lot of dividends, so it might balance itself out. But again, this proves my point that these sort of income producing ETFs will be lagging the S&P 500 index. The ETF number 3 we will take a look at is the BST, BlackRock Science and Technology Trust, which wants to deliver a return to investor through a combination of current income, current gains, and long-term capital appreciation. Under normal market conditions, this ETF will invest at least 80% of its total assets in equity securities issued by US and non-US science and technology companies in any market capitalization range, and these companies are selected for their rapid and sustainable growth potential from the development, advancement, and use of science and technology. As part of the investment strategy, the trust intends to employ a strategy of writing covered call options on a portion of the common stocks in this portfolio. So when we take a look at the performance, you can notice one interesting fact. The dividends are pretty much the same the entire year. It's not like JP or other JP Morgan funds which are up and down with the dividend. This dividend is very stable, the same throughout the entire year, and the yield is currently 9.57%, which is quite a high yield. This fund is again actively managed, and that means we are paying quite a high fee for management. The management fee for this fund is 1%, and in general the expense ratio is 1.05%, which is not that high for an actively managed fund, but when we compare it to the JP Morgan ETFs, they are getting only 0.35% as the management. So they are much cheaper than the BST fund. When we take a look at the holdings, it seems quite similar to those tech ETFs, Apple, Microsoft, Tesla, Alphabet, those large cap companies that are not missing in any portfolio. And this fund is mostly invested in the United States. 81% of the market value is invested in the United States. When we compare the performance of this fund compared to S&P 500, there are some interesting nuances. You can see that this fund actually throughout a long period managed to outperform the S&P 500 even though it paid quite high dividends. But in the recent months it's been just falling like a knife, and it has fallen much more than the index S&P 500, which means that from the year 2014 or 15, the index S&P 500 returned to investors 95.73%, but the BST ETF returned 55.85%, which is almost a 40% difference. But still, you need to account for the dividend this ETF has paid to investors, so it doesn't seem to be that bad of a deal. The number 4 ETF is RAVE's Utility Income Fund. This ETF is focused on the utility sector, which can be considered as a defensive sector in case of a market crash. And this ETF is just like the BST, paying a consistent dividend, $0.19 dividend each and every month, which is very nice to have. And this ETF is yielding 7.85%, which is not as high as the other ETFs we just talked about, but it can be considered quite a stable investment, especially if we take a look at the price appreciation. You can see this ETF has been holding up quite nicely during the recent market crash. When we consider this year's performance, it has been pretty much in line with the S&P 500 performance, but this ETF also paid us a lot of dividends. So I would say this ETF beat the S&P 500 over the short period of time. But when you take a look at the longer time frame, the S&P 500 is just crushing this ETF. This ETF is doing well only in the downturns, essentially, right? You can see like in the 2008-2009, this ETF was pretty much in line with the S&P 500, but since then the S&P 500 has been just on a ride, and it outperformed this ETF by a large margin. The S&P 500 has returned 185% to the investor, whereas the UTG ETF returned only 27.9%, which is much lower. Okay, and the last ETF we will talk about is the PIMCO Corporate and Income Opportunity Fund. This fund is focused on the low level corporate debt. So it is investing in the low grade corporate debt, which means it can yield quite a large yield. It's 11.29%, which is quite a high dividend. And if we take a look, this dividend is quite stable. It is paying $0.1 each and every month. But when we take a look into the price performance, it has been just going nowhere. When you are investing into this ETF, it essentially means you are investing into low-grade bonds, which means it will generate quite a high income. But on the other hand, there is also a high risk of default on these bonds. And in the case of default, you will obviously lose money. So if we compare this ETF to the performance of S&P 500, you can see that the S&P 500, which is this red line, has returned to investors 360%. But the PTY ETF has returned a negative 14%, which is a much smaller return than the S&P 500 index. So these have been 5 ETFs that are paying very high dividend yield. If you have some other high yielding ETF that is your favorite, feel free to write them down below in the comment section. Feel free to subscribe for more investing related content, and I'll see you next time.